Daljeet Kohli is now with us, Head Research, IndiaNivesh Securities. Good afternoon, Daljeet. Thank you so much for taking out time for us. First, if you could start with Axis Bank and explain us that why ARC sales are, taken in so negatively. 1,800 crores, 1,900 crores, they are done with it, but still the numbers were good. Can you just explain us that what sort of fears market has?
Good afternoon, Pankaj. I think the fear that market has is that this concept for last many years has been that private banks are managing their assets very well versus their peers in public sector bank, and therefore if you have to be in banking space, if you want to buy any stock, you should be with the private sector bank. And consistently for last many quarters we have seen that the numbers of private sector banks have been much better than public sector banks. Now this is the first time when we have seen that actually two of the private banks who have come out with numbers have not been so impressive. From HDFC Bank we did not see that kind of impressiveness. Similar thing we have not seen in Axis Bank. HDFC of course does not have any issues with asset quality, but the growth itself was a concern there. Now in Axis Bank, asset quality also has become an issue. Why it has become an issue? Because when the headline number was yesterday announced, it was just that slippages are only 500 something crores. Whereas when you actually add that ARC sale, then it becomes 2,300, 2,400 crores. So that was a kind of a negative surprise that market did not like. Also it has belied that theory that all the private sector banks are doing very well, everything is good, you don't have to worry. We have been always pointing out this fact that it is not possible that if a macroeconomy scenario is bad for the sector, then it can't be that only public sector banks will have a negative impact, private sector banks will remain away or untouched from that. Somehow they've been able to manage in the last few quarters. Maybe this is the quarter when, this is the fear that this is the quarter when we will see those hidden numbers or those issues which were lying latent, they might come out to the surface. And that's what is probably giving jitters to the market.
Right. Can we come out and extrapolate what the markets are doing? Yes Bank is down 3, ICICI is down 2, SBI is down 2.5. You think people can extrapolate or it has to be taken on a case-to-case basis?
I think ICICI Bank you can relate one-on-one because more or less ICICI and Axis Bank do the similar kind of activity. Of course, ICICI has cleaned up its books much earlier and it has concentrated a little more on the retail part. So infrastructure portion has gone a little lower, but still the issues on the asset quality remain on the ICICI Bank. And I think they, in some filing in US, they have also mentioned that they are finding things are tougher in this quarter. So probably ICICI Bank, it is easy to relate that what has happened in Axis Bank you can do. Normally in Yes Bank you don't get this kind of asset quality issues because normally they don't do too much of lending to these kind of companies. But since last quarter this issue has come up in Yes Bank because some of the, I think, brokerages have also written reports that Yes Bank has been taking over exposure on stress assets. So I think this time the fear is that what they did 6 months back or 3 months back, that might show up in these numbers this time. So chances are yes, there are reasons, and I think they are justified, that people can extrapolate the same thing. What has happened with Axis Bank can happen with these banks also.
Any view on Lupin after the numbers? It's down. It was down 8-10% yesterday. It's down 4% today as well.
I think it is coming to a point where one should start accumulating it more because we believe that this is a temporary problem. They have not got the approvals in US in the last few months, and then they went in for few acquisitions, so their costs have gone up. R&D costs have also gone up. That is the reason why numbers are looking subdued. I think probably Q3 numbers may also look subdued, but from Q4 onwards and then FY17 should be looking very strong. So we believe that if somebody has a view of 1 year, 1.5 years, then probably this is a good opportunity to accumulate this stock. How much further low it can go down, probably can't say, but I think the valuation wise also now it is more or less taken care of with this kind of bad numbers. It was a big nasty surprise yesterday, but this has been taken care of in the price now. So I think it's for an investor who is looking for 1 to 2 years, or at least for next 6 months, 2 quarter results. March results should be better, and then next year FY17 first quarter numbers should also be good. So buy Lupin in this fall.
So Daljeet, what do you make of the market sell-off that we have seen in the last few days? A correction was warranted looking in at the overall results?
Yes, Pankaj, I think we were waiting for the results and everybody knew that the results are not going to be good. So obviously there was no reason for the market to really jump up so fast. It was just that in between the no negative news tries to become a little bit positive for the market, and when there are certain flows, then probably you see an upward move there. We have seen that every time when it goes upward, market moves upwards, at every upper band there is a resistance that market stops there. For example, like yesterday or day before, people were talking that 8300 will now be taken off, but from 8300 again it has been coming back again and again. So I guess market is actually right now indecisive in the nature, because they don't know where to go. Results are not panning out. Results are as bad as one would have expected, and in fact even worse results are supposed to come later now. Initially you get good quality of results. Normally you get bad results towards the end of the season. So we will get further more. Then there is this Fed meeting pending on the local side, this elections pending. So there are a few things there where market is in that lackluster mode. It's just trying to, the movement is very, very narrow, from between probably 200 points or so, both ways it is just moving.
Right. What would you make of the story that India is the best place, money is chasing growth, growth is only there in India among the emerging market pack? What would you make of that? Do you buy that argument, or do you say that that is correct, but it's priced in into 8,100 Nifty?
I would answer it like this, that this argument was correct 6 years back also, in 2008 also, in 2 months back also. Probably it will be correct for next 20 years also. So what do you do with this? We know that growth is there, but we also know that this growth is coming along with a lot of riders. There are a lot of risk factors involved. There are a lot of uncertainties involved. So people, when they take a decision, they take in a holistic manner. It's not just one thing, one factor that accounts for all these things. There are many, many things that go in. I guess this long-term structural story, India being a growth story, and that there is so much of population, consumption, all these things will remain there. They are there for next 50 years probably they will remain. We will remain bullish on that part. But to make any sense out of just 1 or 2 indicators saying we have moved upwards on certain indicators, that will mean that suddenly there will be a rush of inflows? Probably not. Also, rush of inflows or fund inflow will also depend upon what is happening across the world, relatively what is happening. If other places relatively are becoming less riskier and are much well known to the investor community, probably they will move towards that side. So I don't think that this one indicator can actually help us in getting too much of flows. Our flows will depend upon the relative performance within the emerging market pack, performance related to what developed markets are doing, and then on our own fundamentals basically. So fundamentals, I think, will be the key criteria to look for.
Right. Can you talk about the mid-cap space? I mean, we've seen a mixed bag in terms of numbers, but we've seen more hits than misses as far as the mid-cap space is concerned, at least the ones that, are tracked, are owned by a lot of funds. What do you make of that? Will mid-cap valuation sustain where they are? Daljeet, I was asking about the mid-cap space. Okay, I think there is some issue with that network over there. We'll just come back with that. But meanwhile, as we were talking to Daljeet, markets are now down a full 100 odd points. Just in the matter of the last 5 minutes, we've lost more ground, 96, but we went down towards the 100-point mark, 8130 mark, and I think it's got to do with the expiry. There are still a lot of call writers in the market. They would be, and also put writers. So the put writers would now start to get worried. Daljeet is now back with us. Daljeet, I was asking about the mid-cap space. The numbers over there look better than the large-cap ones, at least for the ones that a lot of people have been overweight on. You think mid-cap valuations will be sustained?
No, I don't think so. With mid-cap valuations are already on the higher side, and we have not got anything in the mid-cap side or anywhere where there is a very big positive surprise. No, hardly anywhere, except I think until now whatever numbers have come, Alembic has shown some very strong set of numbers, very high number on the profitability front, but that was also to some extent known that last quarter they did not bill in for that one particular drug, Abilify, so that had to come this quarter. Otherwise, I don't think there has been any major improvement on any of the things. In fact, there has been more of disappointments, because one common theme which I could find till now the results was that we were all building in that because of this crude price and commodity cycle downwards, we will see a huge jump in the operating profits of the companies, but that has not happened. I think very few companies have shown substantial jump, and sequentially if you see, actually there has been a fall. So that means that the best of the, in fact, Maruti has already mentioned in its con call that probably the best of this commodity down cycle has already played out. So from here onwards, you may not see that kind of expansion in margins, and all this talk that we do, always we keep patting ourselves that because of the commodity cycle downwards and crude downwards, we will see a huge expansion in margins. I don't think that is playing out as well as people had expected. So that is a big, I think, a bit of disappointment on the result side. In mid-cap, this was more important because there we would many people were expecting that expansion can happen much more and much faster, but that's not happening. So I think it's again a stock-specific story in the mid-cap.
We last time spoke about Force Motors. Numbers over there, did you like them? Can you tell us after the numbers, are you incrementally more positive about Force Motors and the target that we discussed last time?
Yes, numbers were very good. In fact, numbers were a positive surprise on the auto component side, which is what this BMW and Merc business is all about. So there we had built in, they have clocked, I think, 10 to 20% more than what we had already built in. So that means that numbers were good. But for the full year, we have not changed our numbers, because normally we have seen that initial part there is always a higher number and then it gets tapered off. So to be on the conservative side, we have not changed full year numbers. However, we have increased the target multiple for FY17. So that will give us a target price of around 13,850 or 3,900, which is 150, 200 rupees more than what it was previous. But our long-term target of FY20, that is what, 10,000 rupees odd, that still remains. So there is no change.
Right. Daljeet, any new initiation in the pharma pack that you track or any other space?
No, Pankaj, in fact, that is what we are trying to searching very vigorously, where to find a new idea. Most of the mid-cap stocks, as I told you, are already higher priced. So there we have earlier also talked about this fact that even though companies are reporting right numbers, they are delivering what they are promising, but the stock price has already taken into consideration. Therefore, it does not leave any scope for you to enter in those stocks or to restart or a fresh buying in those stocks. So the only thing that you can do is wait. Either the price should correct or the things should improve much faster. So till the time any of these things happen, you have to just wait out. So this time, right now, we are just continuing with the previous calls. We're not adding anything new. It's kind of a reiteration of the previous calls.
Right. Daljeet, do you think this is exactly what is happening with names like Amara Raja Batteries? Numbers were broadly in line. They were just about 1 or 2 crores here and there. In terms of percentage, maybe about 3% here and there. But the name is down about 7% after the numbers. That's precisely the problem that you're facing to find new companies. Expectations for growth are so high that to meet these numbers, if they actually don't meet these numbers, the PE derating can be quite significant.
Exactly. Markets have been too much of in the euphoric mode, and they have built in almost, especially in all mid caps, up to 17, in some cases up to 2018 numbers, and that too on a very high side. So I think that is where the problem is, because expectations are very high. Even though the companies deliver, we find that the stock is not reacting in the way it should have reacted, or as we would have thought. So I think it's exactly the mismatch between the expectation and the delivery.
Right. Daljeet, thank you so much for joining us here this afternoon. Always a pleasure talking to you.